Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into WW International, Inc., WW.
And this is a really fascinating one.
It is, because
Yeah.
this is a company that has gone through not just, a financial restructuring, but a radical transformation of its entire identity.
And it was driven completely by necessity.
Yeah.
I mean, the arrival of GLP-1 medications just changed the entire landscape.
It was a seismic shift. And for you, the
Oh.
listener, if you're preparing for a meeting on this or just trying to understand the turnaround story, it really all boils down to one razor-sharp investment thesis.
Right. You have to be incredibly clear about what the actual bet is here.
Absolutely. The mission is stark and it's quantifiable. WW is betting its $1.15 billion debt reduction, which they got through bankruptcy, and the explosive 60% YoY clinical subscriber growth will accelerate their GLP-1 integrated care model fast enough.
And this is the key part.
Fast enough to overwhelm the really significant 20.2% decline in the behavioral segment and, crucially, drive sequential revenue growth in fiscal year 2026.
So in short, we're analyzing the new WeightWatchers.
Exactly.
They've shed their past, right? A past defined by this massive debt load and, the stigma of being just a diet company.
Mm-hmm.
And now they're trying to emerge sort of Phoenix-like as a sophisticated clinical health technology provider.
And our job today is to figure out if this pivot, both operationally and financially, is real, if it's sustainable, and if the timeline they've laid out actually works for an investor looking for some stability and, a return.
Let's do it.
Okay, let's unpack this financial reset first, because honestly, without this radical intervention, the rest of the story is just, it's moot.
It doesn't happen.
It doesn't. The scale of the debt relief is astonishing, but it was driven by a true existential threat. This story starts with a company that was, frankly, drowning.
Drowning is the perfect word.
A highly leveraged balance sheet just collided violently with the market disruption from GLP-1s like Wegovy and Ozempic.
And their cash flow just couldn't service that debt, especially with the core business eroding under their feet. They had to do something decisive.
Yeah, and when you say drowning, I mean the leverage ratio tells the whole story.
Oh, it does. They were operating at a net leverage of 9.4x in FY 2024.
And just to put that in perspective for everyone, a leverage ratio of 4x is often considered, high risk.
Right. 4x is getting into the danger zone, so 9.4x. That signals severe financial distress.
We're talking about a situation where basically every dollar of operating profit is just gone.
It's consumed by debt servicing. There's no capacity for strategic investment, no ability to weather any kind of downturn.
So facing that reality, needing to fund a massive pivot while shackled by old debt, they took the fastest route possible to solvency.
They did. And they executed one of the swiftest corporate restructurings we've seen in this sector. The impetus was survival, but the method was incredibly precise.
They filed for a prepackaged Chapter 11. That was on May 6, 2025.
And they emerged barely 7 weeks later, June 24, 2025. This whole thing was a surgical strike.
And that prepackaged part is the key operational distinction here, isn't it?
It's everything. It means they went to the court after they had already negotiated and gotten support from the vast majority of their creditors.
Which avoids that prolonged, costly, and usually disastrous uncertainty that you see in typical bankruptcy filings.
Exactly. That prep work meant they could keep the lights on and the business functioning seamlessly. The critical operational win was remaining fully operational during that entire process.
With no impact to members.
Zero impact. If you were a WeightWatchers member, on either the behavioral or clinical side, this reorganization was completely invisible. That's a massive win for retention and for brand continuity.
And the financial win, that Phoenix moment you mentioned, was just wiping the slate clean on the old debt.
The crucial benefit was the elimination of approximately $1.15 billion of legacy debt.
$1 billion.
It's a staggering number,
Yeah.
and it represents a reduction of more than 70% of their prior debt burden. It's a complete financial replatforming.
Now, in the accounting world, when you just extinguish that much debt, it has to show up on the books somehow, right? It creates a huge accounting entry.
It does, and we should clarify that for the listener. Accounting-wise, this generated a substantial reorganization gain, net, of $143.9 million in what they call the predecessor period.
But it's vital to understand that this is a non-cash gain.
Absolutely. It's not cash revenue. It's an accounting purge. It's the difference between the value of the debt they owed and the value of the new equity or debt they issued to settle those claims. It just cleans up the balance sheet.
So they swapped a mountain of old debt for a much more manageable hill. Let's talk about what that new, healthier balance sheet looks like now. What's the new debt structure?
It looks dramatically healthier, and it's focused on sustainability. WW issued $465 million in new senior secured debt.
Okay.
And crucially, this debt is now longer dated. It matures in 2030, which removes that immediate liquidity pressure they were facing.
And the interest rate on that?
The effective interest rate, as of Q3 2025, was about 11.07%. It's calculated as SOFR plus 680 basis points.
So 11% is certainly high. It reflects the risk the new lenders are taking on.
Of course.
But the real win is the volume reduction. I mean, hundreds of millions less in debt means huge cash flow savings, which they desperately need to fund this growth pivot.
Precisely. The core victory here is the cash liquidity it generates. The reorganization achieved projected annual interest expense savings of approximately $50 million in cash annually.
$50 million.
Think about that. $50 million that used to go to creditors is now available for strategic allocation.
And management has been very clear that they intend to pour that cash right back into the business.
Directly into the strategic growth, into funding the pivot to the clinical segment that is the core of this whole deep dive.
And if we go back to that leverage ratio, the turnaround is just night and day. They went from drowning at 9.4x.
So where they are now, which is less than 3x pro forma.
It's a seismic, immediate shift from near insolvency to, operational health.
It changes the entire conversation. It goes from, will they survive the next year, to, can they execute their growth strategy?
They have the financial capacity now.
Right. In terms of immediate liquidity, they ended Q3 of 2025 with a really robust $170.1 million in unrestricted cash.
Now, that's a strong cash position, but there's an interesting little detail on the liquidity, a covenant in the new debt.
Yes, this is a key detail for investors to watch.
It's a mechanism that kind of forces further deleveraging or strategic investment.
It's a mandatory prepayment requirement. Basically, they have to prepay 100% of any unrestricted cash they hold in excess of $100 million.
And that happens when?
During the last 10 days of the first quarter of fiscal year 2026.
So it forces a very strict discipline. They can't just hoard cash on the balance sheet.
Exactly. Any excess capital has to either be used for high-impact investments now, or it automatically goes toward paying down debt, which lowers their leverage even further. It's a use it or lose it situation.
And alongside purging the debt, they're also showing really strict operational discipline.
They are. The company is still on track to realize $100 million in run rate cost savings by the end of 2025.
So they're fundamentally leaner, they're rebooted, and they're ready to deploy this new capital. So looking at the first set of results from the new WW in Q3 2025, how did the top line and profitability look?
They looked stable and positive. Total revenue for Q3 2025 was $172 million.
Okay.
And that resulted in $43 million of adjusted EBITDA.
So that's a pretty healthy margin.
A very solid 24.9% adjusted EBITDA margin. And remember, this is right after massive structural changes and the cleanup from that compounding business earlier in the year.
Right. Which brings us to how the market is viewing the company today. Because despite this huge debt reset and the operational tightening, the valuation suggests, well, deep skepticism.
It does. Analysts have noted the current trading valuation is a very low 4.4x EBITDA.
And that multiple is really the crux of the whole investment debate, isn't it?
It is. A low multiple like 4.4x suggests one of two things. Either the market believes the decline in the core business is so severe that it's going to undermine any future growth. Or the market just hasn't fully digested the financial reset and the operational pivot, which would mean there is significant upside potential here.
It's pricing them as if the declines continue forever.
Exactly. It's not really accounting for the successful transformation or that $50 million in freed up cash flow.
So we've established the fuel for the turnaround, that $50 million cash injection from debt savings. Now we have to move to the engine that's supposed to power the recovery, the clinical segment.
This is where the narrative shifts from financial survival to, hopefully, operational dominance and growth.
This is the whole thesis.
It's the entire growth engine. It's all driven by that integrated care model surrounding the demand for GLP-1s. If this engine stalls, the whole plan fails.
And the numbers from Q3 2025, they show some relentless momentum, even with the volatility from the compounding issue earlier in the year. What does the subscriber base look like?
They absolutely show momentum. Clinical end-of-period subscribers hit 124,100 in Q3.
And the gross.
That is an impressive year-over-year increase of 59.6%. Management just rounds that up to about 60% YoY growth.
That's the metric everyone is watching.
It is. But size isn't the whole story here. The value of each subscriber is everything. This subscriber base, while it's still small compared to the legacy behavioral segment, is disproportionately valuable.
And that massive ARPU differential, the average revenue per user, that's the financial bedrock of this entire transformation.
It truly is. Clinical subscription revenues grew 35% YoY to $25.8 million. And that now represents a substantial 36% of total revenue.
Let's pause on that. This segment is less than 10% of the total member base,
Yep.
and yet it accounts for over a third of the revenue.
And the key metric is that monthly subscription revenue per average clinical subscriber. It stands at 68 points and 32 cents.
$68, and we contrast that with the legacy behavioral ARPU.
The traditional behavioral ARPU is just $16.39.
So let's be really explicit here for the listeners. A clinical member is worth roughly 5x the revenue of a traditional behavioral member.
Exactly. And this explains why management is willing to accept that 20% erosion of the core business.
Right. For every new clinical subscriber they acquire, they can lose 5 traditional members just to stay revenue neutral. It's a crucial buffer.
And that $68 fee isn't just for a prescription. It reflects the whole value proposition.
It's for the holistic model.
Right. Medication access, behavioral science, coaching, community support, all the features designed to increase adherence and efficacy.
Okay, speaking of efficacy, we need to address the compounding issue that created some noise earlier in the year. WW prescribed compounded semaglutide for a bit, but then stopped to commit only to FDA-approved branded meds. How did that transition go?
This was a potential weak point, but it seems like management handled it pretty well. They reported that the transition away from compounding is largely complete.
And the conversion rate?
Approximately 20% of those compounding members successfully converted directly into the higher-priced, FDA-approved clinical program.
Yeah.
Management actually viewed this as exceeding their expectations.
Okay, wait. If 20% converted, that means 80% of the members they were serving with compounded products walked away when the price went up.
They did.
Doesn't that suggest a huge price elasticity risk? I mean, couldn't that hurt their ability to maintain that high clinical AOPU in the future?
That is the critical skeptical view, and it's a fair one. The 80% attrition definitely highlights the risk of price-sensitive customers just flocking to the cheapest available medication source.
Right.
But the company's counter-argument, and the reason they see the 20% conversion as a win, is that the 20% who stayed are the high-value members.
The ones who see the value in the whole platform.
Exactly. The ones who recognize the value of the platform, the safety of FDA-approved drugs, and the continuity of professional care. Management is betting their target market is less about the cheapest pill and more about the best, most medically supported outcome.
So they see Q3 of 2025 as the low point.
The low point in clinical subscribers after that necessary cleanup.
That makes sense. They're sacrificing low-margin volume for high-margin quality. Which brings us to the evidence, the proof of that integrated model. Their competitive moat isn't just access to the drug.
No, it's the fact that their model delivers superior outcomes. And that data is so important.
Why? Why is it the key?
Because that efficacy data is the key differentiator for securing long-term insurance contracts and proving value to employers. That's the B2B market they have to crack to succeed. If they can't prove better outcomes, they're just another telehealth provider.
So what does the data actually show for WW Clinic members after a year?
It shows that WW Clinic members achieved 19.4% body weight loss at 12 months.
19.4%.
And this is a critical metric because it significantly outperforms peers in the telehealth space. For example, providers like Hims & Hers have reported average outcomes closer to 12.2% body weight loss.
Wow, so that's 7.2 percentage point difference? That's not just a clinical win.
No, it's a business development win.
This is the key to unlocking major insurance contracts. Payers and employers are highly sensitive to long-term efficacy because that translates directly into avoided future medical costs.
Exactly. That superior, durable outcome data allows them to justify their platform fee and secure their position against pure-play telehealth providers who might just offer the medication and some basic monitoring.
If they can keep that performance gap, they move from being seen as a diet expense to a clinically validated, cost-saving solution for employers.
Which moves us directly into the strategic alliances they need to scale this high-efficacy model.
Okay, let's pivot to those alliances. They're essential for securing supply, future-proofing the offering, and just smoothing out the patient journey. We have to start with the big pharmaceutical partnership.
That would be the collaboration with Novo Nordisk and VO.
Right.
This partnership is absolutely vital. First, it ensures WW has reliable access to authentic, FDA-approved Wegovy.
which is critical given all the supply chain issues and counterfeit risks that have plagued the market.
It provides crucial stability. But the real long-term advantage here isn't just securing today's supply.
It's being integrated into the next generation of obesity treatment.
Exactly. WW is positioning itself to be a key partner in the pharmaceutical future. They're working closely with NVO to support the anticipated launch of the Wegovy pill,
The oral GLP-1.
the oral GLP-1, which is expected in early 2026.
And an oral medication just fundamentally changes the game.
It changes accessibility, compliance, ease of use for millions of patients who might be needle-averse or just find injections inconvenient. Being a key distribution and clinical partner for that launch puts WeightWatchers right at the forefront of this massive market transition.
So they're hedging against future supply chain issues by being essential to the new product pipeline.
That's the play.
And on the logistics side, they've partnered with an absolute giant to remove friction for the patient.
The Amazon Pharmacy, AMZN Fulfillment Partnership. This is all about simplifying patient access to the medication. It's designed to tackle one of the biggest chronic headaches for telehealth patients.
Just getting the drug reliably and affordably.
Right, the logistical complexity.
So let's elaborate on the specific ways they're reducing that friction. What are the concrete advantages for a member?
Well, the integration is really deep. First, it offers real-time medication availability checks directly from Amazon's huge fulfillment network.
So no more frustrating back and forths chasing supply.
Exactly.
Yeah.
Second, and this is crucial for affordability, it allows for automatic coupon savings to be applied right at checkout. The patient doesn't need to hunt for codes or do complex processing.
And third,
They leverage the massive Amazon network for free 2-day shipping for Prime members. It just adds convenience and reduces another barrier.
the theme here is pretty clear. Let patients focus on achieving that 19.4% weight loss, not on managing drug fulfillment, which is often a huge reason for people dropping off.
For sure.
So if pharma partnerships ensure supply and Amazon streamlines logistics, the final piece of the strategic puzzle has to be securing the payer, getting insurance to cover this whole holistic model.
That is the ultimate B2B play. It's the long-term, high-margin differentiator.
And WW is leveraging its full platform, including this new financing solution called the WeightWatchers RX Flex Fund, to target large-scale employers and payers.
The crucial B2B market. This is where the real money is, and it's where their efficacy data matters the most.
So how does this RX Flex Fund work, and how does it differentiate them when they're talking to a big employer?
The RX Flex Fund is designed to make the whole program accessible to employers who might otherwise find the cost prohibitive. It basically helps bundle the full spectrum of services, medication, coaching, digital platform into a flexible offering.
An offering that maximizes the chance of getting a return on their investment.
A return proven by that 19.4% weight loss statistic.
And what gives them the critical administrative edge against other telehealth competitors? It must be about navigating the insurance maze.
It's entirely about removing administrative hurdles. WW has invested heavily in building an internal, robust insurance PA approval engine.
PA meaning prior authorization.
Right. And getting PA approval is often the single highest hurdle for patients seeking GLP-1 coverage. It can lead to weeks of delay or just outright denial.
So this internal engine is cited as a key competitive advantage.
It is a key advantage against competitors who often rely on third parties or, manual processes.
So if WW can consistently ensure faster, more reliable coverage for its members, that 19.4% efficacy data becomes exponentially more valuable to payers.
They're solving the dual problem: clinical success and administrative access. It's a massive structural shift in the company's DNA.
From consumer-focused discounting to sophisticated B2B insurance sales.
It signals a complete change in business model maturity. They're moving from a volume-based consumer goods model to a value-based healthcare service model.
Now let's look beyond the immediate GLP-1 weight loss battle. Let's look at how they plan to expand their service offering into adjacent markets. This shows some real strategic thinking about expanding their total addressable market.
And the immediate and highly strategic move is into women's health, specifically the menopause market expansion.
This seems like a really natural move for them.
It's highly strategic because it targets an extremely underserved market where WW already holds a massive amount of legacy, customer trust, and data.
And what's the underlying data that validates this move? Why is this market so attractive?
The opportunity is immense. Data shows that 70% of women gain weight during the perimenopause and menopause life stage.
70%.
And it's due to hormonal shifts. This is a significant, distinct metabolic challenge, and it's often overlooked by the broader healthcare industry.
Plus, WW's legacy customer base is already predominantly within that 40 to 60 age demographic.
So it's a natural, highly relevant upsell opportunity without requiring massive new customer acquisition costs.
And what does the new program, which is launching later in 2025, specifically offer?
It offers tailored, integrated support. So this includes specialized care like hormone replacement therapy access, or HRT where it's appropriate.
And specialized coaching, I assume.
Specialized coaching that accounts for the hormonal and sleep challenges specific to this life stage, and targeted nutritional guidance.
And management sees this as more than just a new vertical. They see it as a blueprint for future specialized integrated programs.
Precisely. If they can successfully execute the menopause expansion integrating HRT and specialized coaching into their platform, they prove they can pivot into other complex metabolic health conditions later on.
Like type 2 diabetes or hypertension management.
Exactly, where GLP-1s and behavioral support are also critical. It expands their total addressable market far beyond just traditional weight loss.
This speaks again to that shift from a diet brand to a comprehensive health technology platform. But to deliver on that tech promise, the foundation needs a serious overhaul. The legacy app has to have significant technical debt.
It does. So they're launching a comprehensive digital overhaul to remove those legacy barriers and friction points. A core problem was the siloed experience between the legacy behavioral program and the new clinical program.
Right, it was hard for members to navigate between the two.
Which hindered cross-selling and retention.
Yeah.
The overhaul aims to unify that whole experience.
And the timeline for this crucial launch is inherently high stakes.
It is tied directly to their strategic funding. The first version of this new app is explicitly targeting a launch by early next year in time for the Q1 2026 peak season.
Which is the highest volume recruitment window of the whole year.
It's a high-risk, high-reward bet. Launching a major replatformed application right before January signals tremendous urgency from management. If that app fails, the entire Q1 recruitment wave is lost.
And they're also looking beyond just unifying the app. They're leveraging advanced tech to personalize the service. What about the AI integration?
They're investing heavily in a new AI-enabled platform. It's intended to draw on 6 decades of member data behavioral patterns, food diaries, clinical metrics for truly personalized, dynamic support.
This isn't just a chatbot.
No, this is using deep historical data to inform real-time coaching adjustments. And they are already seeing tangible benefits.
Like what?
Immediate operational wins, improved member resolution rates, and significantly reduced service costs through AI-powered voice support in their customer service ops.
Which is crucial because it frees up their most valuable asset.
They're human clinicians and coaches.
Right. Lets them focus on direct patient care, which reinforces that high-touch service moat we talked about.
Exactly.
Okay, finally, let's wrap this section with the crucial shift in brand and pricing. For years, WeightWatchers was infamous for just widespread, deep discounting.
Right. Constant coupons, low introductory offers. That model, which severely diluted their brand equity, is officially being phased out.
So management is moving away from that history of widespread, deep discounting
toward a new, value-based pricing strategy. They are betting that the clinical efficacy and the integrated model justify a premium price point.
That is a huge shift. For decades, the consumer perception was you could always just wait for the next sale. That's a hard perception to break.
It's radical. And to support it, the marketing strategy is also changing fundamentally. They're shifting focus from expensive performance marketing channels,
like pay-per-click ads,
to a full-funnel strategy built on social and community-driven storytelling.
Using real voices to redefine the brand.
Exactly. The goal is to leverage real voices, doctors, clinicians, to challenge those dated preconceptions of the brand and reestablish WW as the trusted premium authority in weight health.
Okay, let's synthesize this whole investment case. We've covered the $1.15 billion cash injection and that powerful 5x ARPU engine. Let's bring it all together for a final verdict and really rigorously examine the structural risks that could still derail this comeback.
The synthesis is pretty clear. The successful debt reduction provides the fuel, that $50 million in annual cash flow.
Right.
And the growing clinical segment, with its 60% YOY growth and 5x ARPU, provides the powerful new engine. The company is leaner, it's strategically focused.
But the core question remains, is the growth fast enough to counteract the entrenched decline that is still hammering their core business?
And that entrenched decline is our first and most significant structural risk, the persistent erosion of the behavioral segment.
This is the massive headwind they're fighting every single quarter.
The behavioral segment decline reached a debilitating 20.2% in end-of-period subscribers in Q3 EOI. The legacy membership base is just shrinking rapidly.
And it reflects the reality that for a lot of consumers, GLP-1s have made traditional diet coaching seem archaic or, unnecessary.
This market shrinkage is the primary financial risk that the clinical growth has to overwhelm.
It's a race against the clock.
Yeah.
Is the 60% clinical growth accelerating faster than the 20.2% behavioral business is contracting in terms of total revenue impact?
That is the tension that's going to dictate their future stock price. And risk number 2 relates to competition, specifically compounding price pressure, which ties back to that 80% attrition rate we discussed.
Right. Despite WW's commitment to only FDA-approved branded medications, a commitment designed to signal quality and safety, their competitors are not following suit.
Correct. Competitors continue to offer low-cost compounded products. This keeps the market highly competitive, and it potentially challenges the sustainability of WW's high clinical ARPU.
That's $68.52.
Right. If low-cost compounded options remain widely available and effective for most patients, it could make it harder for WW to upsell people to the full-price, insurance-backed, holistic model. It puts continuous pressure on maintaining that lucrative 5x ARPU difference.
And finally, investors need to be cautious about the short-term forecast. The guidance for the end of 2025 introduces a deceleration risk right before their critical peak season.
Management has openly cautioned that adjusted EBITDA is expected to decline in Q4 compared to Q3.
Which always spooks the market.
Always. Now, this isn't necessarily an operational failure, it's a planned strategic expenditure.
They're deliberately increasing marketing investment ahead of that Q1 2026 launch.
Exactly. They are spending money now to position the new app and the refreshed brand for that crucial January recruitment window. But any decline in short-term profitability creates potential volatility.
So bringing it all home, the recovery narrative hinges entirely on operational execution in the first half of 2026. Can the GLP-1 acceleration and moves like the menopause expansion finally stabilize the top line after years of decline?
Well, the current professional estimates suggest that sequential revenue growth, so month-over-month growth instead of just contraction slowing down, will only return later in FY 2026, probably starting in Q3 26.
So investors betting on this turnaround have to have tremendous patience.
They do. They have to wait nearly a year after the debt reorganization to see concrete evidence of revenue stabilization and growth. The post-bankruptcy euphoria is gone. Now comes the slog of execution.
This has been a fascinating journey through a complete corporate identity reset. We've seen a legacy brand shed $1.15 billion in debt, pivot to a 5x higher ARPU clinical model growing at 60% EOI.
While still battling a catastrophic 20.2% decline in its core business.
All pointing toward a potential revenue reversal in Q3 of 2026. The financial foundation is repaired, but the operational platform still has to prove itself.
And the final decision point for investors really centers on the magnitude of that financial reset versus the fragility of the operational overhaul. They have the capital, they have the strategy, but that behavioral decline is accelerating.
So, considering the magnitude of the $1.15 billion debt reset and the immediate critical focus on the Q1 2026 peak season digital launch, are investors essentially betting $465 million of new debt that a single, yet-to-be-seen app update combined with superior clinical results will be enough to finally reverse 6 years of decline?
That is the ultimate tension built into this turnaround story.
It's the ultimate risk.
But if they pull off the Q1 2026 execution, and they maintain that 19.4% efficacy gap, the potential reward at a 4.4x multiple is immense.
Risk defined, portfolio protected.